we want to capitalize on these gains because they're not going to dip forever, right? There's going to be a floor. There was a big jobs report that showed major growth. And so that really made rates take a big nosedive. If these job numbers are strong, then they're going to expect that there's higher wages. And if there's higher wages, people are going to be spending more money. And if people are spending more money, there's going to be higher risk of inflation. So mortgage rates gotta follow suit.
I'm Karl Kyler, your San Diego Realtor. We're back with Matt.Kish of Movement Mortgage. Matt, there has been a lot going on since our last call. We had tons of labor reports, lots of movement in mortgage rates. Let's not jump into the labor reports quite yet, but can you just give us an update on roughly what rates have done since our last call?
Rates have been going pretty well. Everything's looking good so far. Since the middle of August, the trajectory of these rates have really looked good. Really starting to come down towards our marks, Karl. Like the 4% on the 10-year, we're really close. The 30-year mortgage is also looking really good. But again, we want to capitalize on these gains because they're not going to dip forever, right? There's going to be a floor, and we want to make sure that we're capitalizing before it does hit that floor. There's going to be some important news coming up after these labor reports that may kind of stabilize the markets with inflation and other reports that are coming out there, in the coming weeks. So rates have been looking good. Good time to start getting off the couch and start talking about what a refinance looks like, what a purchase looks like, what selling your home and downsizing or buying the next place looks like. So rates are in the last 2 weeks really looking good. And we're just hoping to capitalize on these gains while we can, because we know that they're not going to last forever, right?
Help me, or correct me if I'm wrong. We are at year lows, like a year low right now on rates roughly, but we're not at like last year we had a lower low. Is that correct?
Correct. So we're right now, if you draw these graphs back, right? I'm looking at them right now. You could kind of draw a straight line across where we were almost to the date last year. We were really good territory. And then last year, side by side, the Fed cut the rates. And then there was a big jobs report that showed major growth. And so that really made rates take a big nosedive. But this time around, it doesn't look like the labor numbers are going to be what they were last year. So when the Fed does cut, it may or may not have that same effect. Obviously, time will tell. The Fed is going to be meeting here on the 17th. So the trajectory is looking good right now. Again, when it comes to historically, if you back the numbers back, we're almost exactly where we were at last year before they really took a turn when the Fed cut.
Yeah, we can talk about that a little bit more in a second, but before we get there, let's jump into labor, all the labor reports. We've had a lot of labor reports drop since our last call, and they have had a pretty significant influence on the bonds market, which has influenced mortgage rates. So can you update us on what are we seeing in the labor reports, and how or why are those affecting mortgage rates the way they are?
So, like we've been talking about for months now, right? Months on end, when these BLS reports would come out and these numbers were super inflated, and then we would meet back up in a couple months and we'd see these numbers revised over and over and over. And that happened from, the numbers that we were talking about from last year. It's been happening from last year all the way through June. These numbers have been revised by hundreds and hundreds of thousands of jobs to the less, right? So going back now, the numbers that are being revised from June might actually show the first negative job growth in a very long time. So the job numbers are starting to come back a little more accurate, and it doesn't look like the jobs are there, right? So when it comes to what does the labor reports have to do with rates, right? When it's strong job growth, more people are employed, higher wages, the risk of inflation is going to go up, so are rates, right? But if it's weak job growth, the rising unemployment, less spending, lower inflation, the rates are going to come down. And so we're kind of seeing that, right? The tale of 12 months. 12 months ago, there it was. We were seeing these crazy job reports. So the Fed was like, wow, lots of jobs, lots of money, lots of people spending, high inflation. The rates got to follow that. And these rates follow expectations as well. So as we're seeing these jobs numbers, as the Fed is already talking about cutting these interest rates, or cutting the Fed fund rate, excuse me, the interest rates have already taken that into consideration. And that's why you're seeing this fall. So they're going to follow suit with, if the job number is strong, you're going to see rates kind of back that up. If the job number's low, same is going to be true.
Got it. I think something the audience or our viewers need to be mindful of is this is one of the first time that we're seeing the JOLTS, the ADP, the BLS. They're all kind of synced in the context of a trend. It's going down. And one of the main influencing or main impacting factors is government jobs. Like last year, I felt like our jobs market or our jobs reports were being sustained by so many government created jobs. Well, that's been wiped out. And now this has given us a different insight, real context to how the economy is doing when it comes to creating new jobs outside of government. And that might be a truer, more of a realistic view of how the economy is doing.
Yeah, correct. And now that we're seeing these numbers revised and where the economy is actually going, you're seeing the Fed, kind of taking their foot off the brake to make sure that, it doesn't go into hawk all at once, right? They want to make sure that they're keeping their foot on the gas or the brake properly to make sure that the economy is stabilized.
Yeah, I agree 100%. There's an economist I follow who advocates labor over inflation, and with inflation going up, and I'll say that very loosely because it's all kind of meeting expectations, but it's been ticking up. If you look at core, what's the, they don't do CPI, they do PCE.
Yeah, it's there's so many different measures of what these folks look at when it comes to labor markets, and that is also needs to be modernized and updated and make sure that it's current, right? We can't have half the people looking in the rear view, and we can't have half the people trying to be forward thinking when they don't know what the data is. So it's got to be data, heavy, but it's got to be the right data. It's got to be current data.
Yeah, I agree with you. So the Federal Reserve follows PCE. PCE has been trending up very slowly, but now that our labor market, my apologies, not labor rates, but labor market is showing weakness, and we have all of these different trackers or metrics that are trending in the same direction, it's finally the time, and how convenient that it's practically exactly a year later from the last Fed rate cut, that the Feds are going to step in and say, okay, cool, we need a rate cut. Our labor market is shifting. So despite inflation, PCE, the metric they use, despite that going up, the labor market is more of an influential factor to determine if Fed funds rate is going to drop, which again, just as a reminder, does not inflect mortgage rates. Now let's circle back to mortgage rates. How we had these reports that dropped in the last weekish or so. What is it about these labor reports that's pushing mortgage rates down? Why do they have that effect on them?
Like we said earlier, man, it's going to be all about the expectation of the markets, right? So if these job numbers are strong, then they're going to expect that there's higher wages. And if there's higher wages, people are going to be spending more money. And if people are spending more money, there's going to be higher risk of inflation. So mortgage rates gotta follow suit, right? So if there's weak job reports and there's less spending and there's less inflation pressures, then these things got to be pushed down. And as we're seeing, the last two jobs reports were super low. And if these numbers are revised, we're going to see negative job growth from June, July, and August. And it's already being kind of baked into the market expectations, right? We're seeing these expectations live in these mortgage interest rates.
So with the job markets reports coming in low, that is causing concern in the investor market. So that would probably drive people to invest in the 10-year yield, which will push the 10-year yield down, which mortgage rates follow. Is that loosely what's kind of happening? Got it. Okay. So before we wrap it up, let's just kind of address where we got a Fed funds meeting on the 17th, you said, I think, and it's like it's super high chance that they're going to cut rates. This time last year when this happened, they cut rates and mortgage rates went up. What are your expectations for this year if the Fed cuts rates?
I'm not expecting it to get as bad as it did a year ago, right? But again, like we talked about earlier in this meeting, it can't keep going down forever. Right? It's going to go down and hit a trough. The economy shuffling its cookies, tick back down, take it out of one market, but it's going to be peaks and valleys. And right now, making sure that we're been hitting down a good little valley, and eventually we're going to hit that valley floor, and that's going to come up soon, I would imagine. But as far as if the Feds cut the rate, a quarter is probably what they're going to be cutting it. Is that going to directly influence mortgage rates? Probably not. We might see a day or two ahead of time what is going to happen with mortgage interest rates, because it's all about the expectations, right? It's all about what the market's hearing, what the market's feeling. And so if they feel like this cut is going to influence the mortgage interest rates negatively, you might see that in the market a day or two ahead of time.
Yeah, one of the things that I think that people kind of have a little bit of a misunderstanding of is they think that like once the Fed rate cut happens, then mortgage rates will be influenced. And again, there's no direct connection between those two. I almost feel like the market tends to be more reactive after the Fed meeting minutes are discussed. Like after Jerome Powell, like they have their meeting, they decide to cut rates, and then some, however long it takes after days or whatever, when Jerome Powell actually speaks, just like at the recent meeting at Jackson Hole, like that's when the market tends to be a little bit more reactive to what he's saying. Because now he's saying, last year when they cut rates, they said, okay, we're probably behind on this. We probably missed the mark. We probably should have cut sooner. The market was super reactive to that. And so I kind of anticipate the same thing. And I think I agree with you. Rates have come down so much. If you're a first-time buyer and we're able to negotiate a 2-1 buy down, if you're in the mid sixes, you're going to get your first year at an interest rate roughly in the mid fours, your second year in the mid fives, and then your third year will be mid sixes. And these are rough estimates. Obviously, talk to Kish about what your specific dynamic and situation will look like, but just as rough numbers, it doesn't qualify you to get you into the home, obviously, but it'll give you those first 2 years of just acclimation and breathing room as you kind of settle into your home, especially as a first-time buyer. And then also, if it's the case that rates settle down more over the next 2 to 3-ish years, you have that opportunity to refi into a lower rate while still benefiting from a little bit of a softer payment in the first couple of years. So I think that there's just massive opportunity. I agree with you. I think that we might be hitting the trough right now based on just trends, right? We hit low, and then we kind of trickle up, and then it sits up there for a little while, establishes a new kind of trend of where we're settling at. Like I remember when we settled around about 6.7, 6.8, we were there for a long time. We were like just trying to get below 7. And then finally when we got below 7 and we didn't bounce up and we stayed there for a little while, it's like, I remember I was reporting it on my San Diego Market Matters on Sundays. It's like, wow, this is the 3rd week in a row we're sitting below 7%. It was like just so crazy that it was like a big deal that we went 3 weeks in a row sub 7. So we'll probably see a similar trend here. Well, can you give us a little bit of an insight what you expect rates to do between now and our next video together?
Man, putting me on the spot. Well, let's just say this, right? Remember those couple days in April where it was like, man, I really wish we would have locked interest rates. We're there, right? We're there. We could do the same thing with those couple days, that finite kind of period of time in April where it's like, oh, it came and it went. We're there. It's here. So if that gives you any bearing on kind of where the market's at today, we're in a good spot. But again, peaks and valleys, right? We're coming down this valley floor. We're going to hit the floor, and it may continue to go down, or it might bounce back up a little bit. Let's have a conversation and see where you sit today and where it's going to go for you, because these mortgage interest rates are fingerprints, right? We all got one. They're all different. right now on a conventional loan, you're sitting in the sixes, hopefully, with decent credit and minimal debt. But we didn't really talk about, there are some opportunities in the fives right now for VA buyers and FHA buyers. So we're right there for a lot of folks who have been waiting. Is it right for you? We don't know. But man, we're in a good spot. We've been waiting a long time to be in this kind of area with interest rates. So here we are. Let's figure it out.
That fingerprint analogy is so spot on. And I think this is a really good opportunity. And I want to encourage, if you're watching this video, if you're on the fence, you're like, oh, well, maybe we should just wait for it to go down a little bit more. Call Kish now and just look at the payment scenario. Be like, hey, with my current financial situation, what would my payment be at this price? And if I waited for him to come down 0.1 or 0.2%, what would it look like then? And then kind of measure your risk assessment, because if you're waiting for them to come down 0.1 or 0.2, they can just as easily go up 0.1 or 0.2 at the same time. So it's like, what are you willing to risk? Are you willing to risk just a couple $10, $20 a month versus missing the opportunity of where the payment is right now? A lot of people I find are waiting for a magic number, and we are just so far out from that. I'm starting to finally get clients circle back to me from last year, maybe even 2023, like late 2023, when they're like, oh, we'll just wait till rates get into the fives. We'll just wait till they get down there. And they're realizing, holy crap, now they're starting to worry if they're really gonna, and when they think fives, they were thinking like low fives, They're like realizing, holy crap, we've outgrown this house. We weren't expecting to wait this long. We need to start planning to make a move now, and we've saved during that time, and it's ready to make a move. And they're starting to like open up the conversation. They're like, okay, well, what's my payment? They're not even concerned about rates. They're saying, what's my payment now? So we'll end there. Thank you for the update on the labor reports and the mortgage rates. I'm really, really excited for our next meeting in 2 weeks to see how this is going to settle down after the next Fed fund rate meeting, and then those minutes when Jerome Powell speaks about what they talked about and kind of the trajectory they're going to go. Because I think there's a lot of expectations that we're going to get a cut this month in September and then another cut in 6 weeks, or we're at least going to get 2 cuts this month or before the end of the year. So I'm really excited to see like how that's going to affect the markets and what mortgage rates are going to do and what the bonds market's going to do. So thanks for continuing to keep us updated. Do you have any closing thoughts or contributions you want to leave the audience?
No, it's my pleasure. Just give me a shout. You guys got any questions? Let us know. That's what we're here for. Here to educate, here to make it known. What could we do for you? How could we help you get into your next spot?
Phenomenal. I have Matt.Kish's contact information in the description below. Just call him and have the open conversation. He doesn't make you sign anything. Just start the conversation there and see what opportunities are available for you. I have clients regularly go to Kish that are 6, 8, 12 months out from buying. It's just getting the conversation started. It's getting their financial position, or getting them in the right financial position so that when they are ready to buy, they're ready. Like they can strike when the iron's hot. So thanks for showing up and joining us again, Kish. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you next video.